So we'll be diving in this afternoon on the wonderful topic of market value adjustments. So today's session, we will explain the differences between different types of interest-bearing accounts, establish what an MVA or market value adjustment is, review why they're important. We'll address the current climate surrounding MVAs, and then discuss some best practices around these MVAs. So the beauty of working with certain providers, especially insurance companies, are there's options in the capital preservation bucket, whether that's a fixed account, a guaranteed option, or a stable value account. Having options is imperative. What are some things to consider in this environment? First and foremost, what's a market value adjustment? An MVA is when the value of an account is adjusted from its book value to its market value. If the market value is more than the book value, it is considered a positive MVA. If the market value is less than its book value, it's considered a negative MVA. It varies by contract, but fixed, guaranteed, and stable value accounts often require a market value adjustment if a certain percentage of the assets are liquidated all at once. MVAs typically occur when the assets are liquidated at a plan level, but can also apply to a single participant if his or her assets are enough to trigger one. The purpose of an MVA is to protect the overall stability of the account. What is a 12-month put? And we also come across these in this environment right now. Similar to an MVA, 12-month puts are another protective measure used by certain accounts, typically a stable value fund. 12-month puts can apply when the plan level distribution is requested, or if the assets are significant, a single participant could trigger one. When this occurs, the assets can be held for up to 12 months following the distribution request. So why are these 12-month puts or MVAs an issue? It's a hot topic right now, considering the current landscape we're in, and we'll start with maybe a little bit of refresher from Finance 101. You're looking at the U.S. Fed funds rate over the last 10 years. You'll note that starting in early 2022, we've seen a consistent uptick in rise in interest rates, which we haven't seen since the early 2000s. So what does this have to do with your client's 401k account sitting in a guaranteed account right now? Well, we'll go back to the inverse relationships of interest rates and bond prices. So a few things to consider. You have to consider the underlying holdings in the guaranteed fixed and stable value accounts. They're typically short to intermediate term, high quality government bonds. And going back to our finance classes, you recall, again, the inverse relationship between bond prices and market interest rates. So when your client requests to liquidate the assets in one of these accounts to move to a new service provider, the manager of the account had to sell the underlying bonds in a decreasing bond price environment to generate the necessary cash. And without a market value adjustment or 12-month put, the only way to pay out the assets on demand at book value would require taking principal or interest from other investors, and that would not end well. So to help make this make sense, we put together a little case study here that we'll run through. We'll assume that you have a client with a $3 million 401k plan. $250,000 of that is in a fixed account with an annualized crediting rate of 150 basis points. Your client decides that they choose to move to a new service provider. After looking through a few options, they make their selection, and then the onboarding takes place. And then the wire transfer associate creates notices and talks to the incumbent provider, and liquidation notices are sent to that incumbent provider. Then the moment arrives that we've seen too often right now, an email explaining that there's a 10% market value adjustment will apply to the $250,000 in the fixed account, which would be roughly $25,000. The plan sponsor is asked to choose whether they'd want to proceed with the market value adjustment and get a transfer of 225,000 instead of the 250, or make the option to transfer the assets at book value, but only 20% of the assets would transfer over each year for a 5-year period. So these are conversations that we're having each and every day. How could we have maybe pre-planned for a situation like this? We could do a couple options. Option one, proceed as planned. This probably isn't likely unless the participants choose to individually move their assets out of this account prior to the transfer, and looking at the contract to make sure there's no look back period in that contract. Second option is the new service provider might have an option. Here at Principal, we have a few options to help mitigate that surrender charge, whether it's a plan level charge, or we can do a rate reduction to our fixed account to provide a buyout of the MVA. Or the third option would be to transfer the assets based on the contract terms and use a help from a third-party administrator to assist with that. So there's some best practices out there when you're managing and going through these MVAs. First, review the investments early in the proposal process. We love to see a plan level asset statement prior, figuring out how much is actually in the fixed account, what we could do to, again, mitigate some of these challenges. You want to discuss options with your TPA. You want to discuss options with the wholesaler and the record keeper that you're working with. Figure out those options, and then ultimately present those options to the plan sponsor and the client and go through those. And then again, make sure you document everything and going through that due diligence process with your provider and your client. So again, I flew through that pretty quickly. But again, at Principal, we have had a few choices and options to help clients through that. First option is what we call a surrender charge account crediting option, which we would charge the plan and all the participants an amount to buy out the MVA. Or we leverage something that's maybe unique to Principal. We do a little bit of a rate buy down on our fixed account, map the fixed money over to our fixed account with a rate buy down. But I guess again, at the end of the day, it's important to discuss these options to try to mitigate some of the challenges that might happen when you get that MVA email from the liquidation. With that, I'll open it up to some questions, and happy to go through those.
Perfect. Thank you so much, Kevin. We did have a question come through. Would using a money market fund instead of a stable value fund help alleviate the MVA problem?
It would if you didn't have a guaranteed option or a stable value or a fixed account. If you had a money market, you wouldn't have those MVA issues, and those have been conversations that a lot of advisors and clients are evaluating right now.